Good afternoon, everyone. We are representing Apollo Global Management, and today we're presenting our strategic acquisition and partnership analysis of Block Inc.
Today's presentation covers 7 sections, starting with our executive summary and investment thesis, moving through the company overview, intrinsic and extrinsic analysis, our business model and financial feasibility canvases, and closing with our acquisition recommendation. Let's get into it. Starting with the executive summary. The core thesis is straightforward. Apollo should pursue a strategic acquisition or partnership with Block to gain exposure to one of the most scaled and differentiated fintech ecosystems in the market today. Block operates across three interconnected platforms: Square serving small and mid-sized merchants, Cash App serving over 57 million consumers, and Afterpay providing buy now, pay later functionality integrated directly in the Cash App card as of early 2025. Four numbers tell the story. Gross profit grew from 7.6 billion in 2023 to 10.4 billion in 2025. That's a 37% increase in 2 years. Operating margin flipped from negative 1% in 23 to positive 7.3% in 25, meaning that business is crossing the sustained profitability. The ecosystem spans both sides of a transaction, merchants and consumers, which creates network effects that are very different for a single product competitor to replicate. And the market cap of approximately 36 billion with S&P 500 membership as of 2025 is a liquid, institutionally recognized asset. The key risk, regulatory scrutiny, Bitcoin exposure, revenue growth slowdown, are real but manageable, and our recommended phased partnership structure is specifically designed to mitigate them. The bottom line is proceed. Now let me give you some background on Block as a company. Bitcoin Inc. was founded in '09 by Jack Dorsey and Jim McKelvey. Originally a Square, which most people know from the little white card reader that changed how small businesses accept payments. The company rebranded the Block in '21 to reflect its evolution beyond payments into a broader financial services platform. It trades on the New York Stock Exchange under the ticker XYZ, changed from SQ January 25. It's headquartered in Oakland, California, and was added to the S&P 500 on July 23rd of last year. The business operates across four distinct segments. It's important to understand each one because they serve very different customers. Square is the merchant-facing side. Point-of-sale hardware, payment processing, payroll, lending, and inventory management, primarily for small and mid-sized businesses. It generated approximately 3.9 billion in gross profit in 25 and is the stable, cash-generating anchor of the business. Cash App is the consumer-facing side and the primary growth engine. It offers peer-to-peer transfers, a debit card, stock investing, tax filing, and Bitcoin trading. Essentially, a full-service digital bank for consumers who don't want a traditional bank. Cash App generates approximately 6.3 billion in gross profit in 2025, making it the largest segment by profitability. Afterpay is Block's buy now, pay later product, acquired in 22 and fully integrated into Cash App in early 25. It targets roughly 70% of Gen Z consumers who prefer installment payments and competes directly with the firm. And finally, Bitcoin TBD. Bitcoin trading through Cash App drives significant user engagement, while TBD is Block's open developer protocol for decentralized financial services, representing the longer-term innovation layer of the business. What makes Block unique is that no other company in the space connects merchants and consumers in a single closed-loop ecosystem at this scale. That's the foundation of the acquisition case.
Starting with intrinsic analysis, this is just looking at how Block has been performing over time. They reached about 24 billion in revenue and 10.4 billion in gross profit in 2025, and margins are now over 43%. So it's not just that the business is getting bigger, it's also becoming more profitable as it scales. And that is important because it shows that they're improving how they monetize their products, not just adding more volume. If we look at a bit closer at how this is happening, we can see that revenue growth has slowed down a lot and it's basically flat in 2025, but margins are still going up. So instead of focusing on growth, growing fast, they're now focused more on efficiency and profitability. And this is pretty normal as companies grow. They shift from chasing growth to focusing on profitability. And you can clearly see that when we look at their costs, all their major expenses are going down as a percentage of gross profit. So even though they're still investing in the business, they're doing it more efficiently, meaning they're keeping more of their dollar to they earn, which is a sign of operating leverage. And that profit is mainly coming from two areas. And the first one is Cash App. Cash App is driving most of their growth, growing 2 billion in gross profit in just 2 years. And the other one is Square. Square provides more stable and consistent revenue. So they're not relying on just one side. They have both growth and consistency, which reduces risk while allowing for expansion.
All right, let's move into the extrinsic analysis. My role was to evaluate how Block performs relative to its peers in the broader market. I want to start with revenue because scale matters when you're making an acquisition case. Looking at the chart, Block grew from 9.5 billion in 2020 to 24.2 billion in 2025, nearly a 2.5 times increase over 5 years. For context, PayPal is still the larger company at 32 billion, but PayPal's growth has been relatively flat over the same period. They went from 21 billion in 2020 to 33 in 2025, a much slower trajectory. Toast, the restaurant point of sale peer, came at 6.15 billion in 2025, growing quickly up 24% year over year, but still a fraction of Block's overall scale. What this chart is really telling us is that Block built significant revenue scale in a short window, and while growth has moderated recently, only 0.3% in 2025, that's actually a sign of maturation rather than deterioration. The story is shifting from top-line growth to margin expansion and profitability, which is exactly what the next slide addresses. This slide is where Block's story gets really interesting from an investor perspective. On the left, you can see Block's gross margin expanded from roughly 25% in 2021 all the way to 43% in 2025. To put that in perspective, it has essentially caught up with PayPal, which sits at 41%. And PayPal has been in this business for over 25 years, while Block got in there in under a decade. That margin expansion reflects a fundamental shift in the business mix, away from low margin Bitcoin revenue and hardware, and toward higher margin software subscriptions, lending, and Cash App financial services. On the market cap side, the right chart tells a story of sector-wide repricing. PayPal peaked at 278 billion in 2020 and has declined dramatically to around 37 billion today. Block peaked around 130 billion in 2021 and now sits at 36 billion. What's notable in that Block and PayPal are now essentially the same market cap, despite Block having a faster growing profit line and a more diversified ecosystem. That gap in valuation relative to fundamentals is a core part of why this is an attractive entry point for Apollo right now. Now let me walk you through the risk profile and stock performance. Block carries a beta of 1.37 on a 5-year monthly basis. That means Block stock has historically moved about 37% more than the broader market in either direction, so it amplifies both upswings and downswings. For Apollo, that beta needs to be reflected in your hurdle rate and discount rate assumptions when you're underwriting this deal. That said, I want to contextualize that risk. The index performance chart shows that Block and PayPal have tracked almost identically since 2020. Both sold off sharply in 2022 during the rate hike cycle and have only partially recovered. Toast, which IPO'd in 2021, has actually outperformed both on a relative basis, which is a testament to its vertical focus. But the key point is that Block stock decline from peak is not a business story. It's a macro repricing of growth assets. The underlying fundamentals, as we've seen, have actually strengthened. 3 data points that reinforce that view. Block was added to the S&P 500 in July 2025, bringing institutional ownership tailwinds. In February 2026, the stock jumped 24% in a single day on the back of a Q4 earnings beat, net income of $1.1 billion for a quarter. And current market cap is $36 billion versus $130 billion peak. Meaning Apollo is looking at an asset trade at roughly 27 cents on the dollar relative to its prior high water mark. This table is where I'm going to bring the competitive picture together. Block goes up against 5 primary competitors, each attacking a different part of its business. PayPal is the closest analog at scale, digital wallets, and P2P payments. But its gross margin has been flat to declining, while Block's has been climbing. Stripe is the most formidable competitor in online payment processing and developer of APIs. Privately valued at $70 billion, both no public financials and no consumer product to speak of. Toast competes directly with Square for restaurants and is growing fast, but is entirely vertically specific and has no consumer ecosystem. Adyen targets large enterprise merchants, the upper end of the market Block is trying to move into, and the firm is the direct BNPL competitor to Afterpay. What this table makes clear is that no single competitor replicates what Block does across all 4 dimensions simultaneously: merchant point of sale, consumer P2P, BNPL, and Bitcoin. That multi-product platform is the moat, and at 43% gross margin, $36 billion market cap, Block compares favorably to every public peer on a risk-adjusted basis. Apollo is not buying a single product fintech, it's buying an ecosystem.
I will now cover the financial feasibility canvas. We will answer 3 questions. And the first question is whether customers actually want this product. And the answer is yes. Cash App already has a strong adoption, especially among underbanked and younger users like millennials and Gen Zs that age between 18 and 34. So this is not about creating demand. It's about expanding on what's already widely used. That makes it easier to grow because the user base is already there. And the next question is whether this model is actually practical to implement. So from the feasibility standpoint, integration is not simple because of block system and regulatory requirements. But building something like this from scratch would be significantly harder and more time consuming. Block already has the infrastructure, license, and data, which creates a strong advantage. So even with the complexity, acquiring or partnering is still the more realistic option. And that brings us to whether the model actually makes financial sense. They generated about $10.4 billion in gross profit in 2025, and margins are continuing to improve. If we were to assume around 17% growth, that puts them roughly $12 billion next year, which shows that there's still strong upside. What really matters here is how they grow as users adopt more service like credit or investing. Revenue per user increases without a big increase in cost. This means growth becomes more efficient over time, which is what makes the model scalable and sustainable.
Finally, let me walk you through the proposed deal structure and our recommendation. We are proposing a phased approach, beginning with a strategic partnership and building toward a full acquisition over 12 to 18 months. The implied interest value is $36 to $40 billion on a market cap basis. The structure is 70% cash, 30% stock, financed through leveraged debt with earn-out provisions tied specifically to Cash App monthly active users and Bitcoin revenue milestones, which protects against the 2 most volatile components of Block's business while keeping management incentivized. Our governance, Jack Dorsey retains the CEO role, and Apollo secures a board seat. Integration will be phased across 18 to 36 months, starting with Square merchant payments, then Cash App, consumer products, and finally the Bitcoin and TBD layer. On risk, the only high-rated factor is regulatory. CFPB, OCC, Doge, FTC Review will all be required given Block's consumer financial services footprint. Their main risk: revenue growth, maturity, Bitcoin volatility, integration complexity, and key man dependency on Dorsey are all rated medium and are directly addressed by the phase structure we are recommending. So given that risk framework, here's our final. Our assessment across all three dimensions is clear. Desirability is strong. Block's consumer base is exactly the demographic financial services firm wants to deepen with, particularly the underbanked and Gen Z segments that are underserved by traditional banks. Viability is strong. Gross profit grew 37% from 2023 to 2025. Operating margin turned positive, and operating leverage is confirmed across every expense category. Feasibility is moderate. Integration is manageable given Block's API-first architecture and a disciplined phase plan. Our recommendation is that Apollo should proceed with a phased strategic engagement with Block. The next steps are clear. Engage investment banking advisors for a fairness opinion, initiate DOGE and FTC regulatory pre-clearance, and execute an NDA to begin exclusive due diligence. This is a generalization entry point into a scaled, two-side fintech ecosystem, an evaluation that does not yet reflect the platform's full potential.